Welcome to Expert Talks by Kalkine TV. And today's guest is Harry Scherzer. He's the CEO at Future Forex South Africa, a high-yield arbitrage trading company whose team's research allows their clients to make the most of the opportunities available in DeFi, or decentralized finance, to earn those impressive returns on investment. And the DeFi market cap at the moment is about $54.40 billion, which increased today in the last 24 hours by about 26%. So here to tell us more is Harry Scherzer, CEO at Future Forex. Welcome to the show, Harry.
Sage, thanks so much for the invite. I'm really excited about this.
Well, Harry, we are so grateful that you have time to share with us some insights from this trending space. So DeFi and high yield arbitrage, let's just jump straight in there. They're fairly new concepts. What do you see as the main difference between earning yield from DeFi as opposed to where a lot of the investment is at the moment traditionally in the bond yields?
Yeah, no, it's a great question, Sage. And before I go into it, I do want to just clarify the difference between high yield arbitrage and DeFi. So I typically work in the high yield arbitrage space. My company does that for clients. And let me just explain what's meant by that. So I'm from South Africa, as you may have picked up from the accent. And in South Africa, cryptocurrencies like Bitcoin tend to trade at a 2 to 3% premium compared to those abroad. So that means that if we can buy cryptocurrencies abroad and simultaneously sell them on the South African exchanges, we can make extremely low risk, high yield returns for profit for clients by doing this over and over again with the same money. You know, you keep making that, call it 1 to 2% net profit for clients, and they do it over and over again and make a lot of money. And maybe it's worth using non-cryptocurrencies to explain this a little bit further. So let's use avocados as an example. Let's say in Australia, an avocado costs two Aussie dollars, and in South Africa, you can sell each avocado for $2.50. And let's say the cost of shipping avocados from Oz to South Africa is 20 cents. Then you'd agree with me that you can make 30 cents per avocado. And effectively, this is what we do for clients by holding avocados in South Africa and being able to buy abroad and sell simultaneously in South Africa. We can make extremely low risk, high yield returns for clients. Now, by doing this over and over again, like I mentioned, our average annualized return for clients is upwards of 80% per annum, which sounds exceptional, obviously. But I do need to caveat why this just can't be done by everyone and why not everyone's making these ridiculous returns. Arbitrage is exclusively available to South African investors, so South African individuals. And this is what allows for this high return because of limited market participants. So, Sage, now that I've clarified what exactly arbitrage is and what we do, let me run through your initial question, which is DeFi and stuff like high yield arbitrage are obviously brand new and very different to typical traditional finance instruments like bonds. So the main difference between DeFi and bonds is that they have the ability to make higher returns, but at the same time, they tend to have higher risk. So let me run through each of those. So the greater returns. So returns can come in two forms, either in terms of coins. So let's say that you invest in Ethereum and you own 10 Ethereum. You can make maybe 1 Ethereum per year of 10 Ethereum, which is 10%, which is really a really great return. But they also come in the form of something called stablecoins, which are coins that are pegged to, for example, the US dollar, which means that they peg to cryptocurrencies. So if you can make greater returns in stablecoins, and we've seen in the market, you can make sort of 20% per annum on a stablecoin. That's far better than you'd be able to earn on a bond or in any bank or anything like that. And yet it's pegged to a currency. So surely this is a better option. Well, not so fast, and that moves into the greater risk element, which I mentioned. So for coins, there's an obvious price risk. If you have 10 Ethereum and you make 1 Ethereum per year, that's great, or 2 Ethereum per year, you make 20%. fantastic. But if Ethereum halves in price, your 12 Ethereum by the end of the year is worth less than your 10 Ethereum was at the beginning of the year in dollar terms. So that's the major risk for coins. For stablecoins, there's also a risk, which is the risk of depegging, which is basically, even though it's one-to-one, supposed to be one-to-one with, let's say, a US dollar, we've actually seen this very recently. A stablecoin called UST has depegged and is currently sitting at around 40 cents per dollar. In other words, if you paid $1 for each one, you can only reclaim 40 cents per dollar on each one, bringing it back. And I won't go into a rabbit hole on why it depegged, but in a nutshell, there's a lot of research that needs to be done on which stablecoins are reliable, which stablecoins have the correct collateral backing them, and which don't. And in UST's case, it was fully backed by cryptocurrency, meaning that when cryptocurrency had a big fall, people lost faith in the stablecoin. Now, there's a third risk, which is applicable to both coins and stablecoins, which is the risk of crypto-specific risks. For example, rug pulls, security faults, impermanent loss, and these are risks that you can't really get away from, but you can manage by doing research and understand them better. A rug pull, just to give you some context there, a rug pull is a malicious sort of attack by creators of coins, whereby what they do is they create a coin which didn't really have any value in the first place. People buy it, they get dollars for these coins, and suddenly they run away with the dollars and your coins are worth nothing. A security fault, on the flip side, is not actually malicious by the creator. It's just potentially negligent in that their coins weren't as secure as they should have been, and a third party comes in, finds a security fault, and performs a hack or similar, so you lose your holdings due to a third party attack. So these are all risks in the DeFi space, and of course, with these incredible returns, there would have to be bigger risks, otherwise everyone would do it. But if they managed correctly, if the risks are managed correctly and understood correctly, then there really are some fantastic opportunities in this space.
Thank you, Harry. It certainly sounds like a 24-hour job being abreast of everything that's going on in high yield arbitrage and the market in general. And I guess that's why companies like yours that have researchers who are focused and dedicated to the charts and what's happening can really benefit someone who's looking at beginning investing. So DeFi, you've now clarified for us that what you do is a little bit aside from DeFi. Is that correct?
Yeah, I'd say it's a little bit different, but we're definitely in the same space.
Right. Okay, thank you for clarifying that. So DeFi is based on the capabilities of smart contracts and dApps, mostly built on Ethereum, this fantastic technology that's opening so many invisible doors for many people. Is it true that Bitcoin, the first cryptocurrency that was invented, which has the largest market cap at present, does Bitcoin have the same potential to do everything that Ethereum can?
Sage, the short answer is no, purely because they actually had different purposes when being created. So Bitcoin is primarily designed as a decentralized alternative to traditional currencies, I should say, and is therefore used as a store of value. Obviously, the price volatility of Bitcoin has hampered its adoption as a medium of exchange or as a store of value. And this is where cryptocurrencies like stablecoins come in, because they obviously are supposed to be pegged to a dollar, which is far more price reliable. So just as an aside, we've actually partnered with a stablecoin company called Circle. They're busy being regulated in the US and have fully their collateral is fully dollar based. So we really see them as a safe stablecoin, and we've been using them to do our arbitrage in an efficient manner. Now, something about stablecoins, what's interesting is they're not actually built on Bitcoin, on the Bitcoin blockchain. Instead, they use other blockchain networks like Ethereum, and this is maybe a good segue into how does Ethereum differ. So, in a nutshell, Ethereum is a programmable blockchain that finds application in numerous areas, including DeFi, smart contracts, NFTs. And without blockchains like Ethereum, DeFi wouldn't be possible. They're basically meant to do more meant to achieve more, use smart contracts, and therefore have more vast technology. Now, while the likes of Bitcoin are purely being the blockchain is purely being maintained, it's not really being developed, in that it's reached its goal from a tech point of view. It's reached its goal of being a store of value. Ethereum, on the other hand, is constantly being improved and developed, and Ethereum F2.0 is set to be released at the end of the year, actually, which will have a number of enhancements, including, probably most notably, a change from proof of work to proof of stake, which basically one of the major advantages of which is that it's better for the environment. So effectively, in a nutshell, Bitcoin is meant to be a store of value. It's meant to be an alternative to traditional currencies, but in a decentralized way, whereas Ethereum is meant for a totally different set of purposes, and has been used to build things like stablecoins, which may supersede Bitcoin as a better store of value, but only time will tell on that front.
Fantastic. Thank you so much for clarifying that for us. I've always wondered. So crypto can also be traded against fiat currencies. Is that so? And what are the advantages of doing this, please? And would crypto be considered an exotic currency such as the peso or the dirham, for example?
Let me start with your first question, Sage, about the advantages of trading crypto against fiat currencies. And I think this is where, for me, the most practical uses come in of cryptocurrency as a whole. In that, for me, it's effectively a game changer in the remittance space, because it allows for ease of cross-border transactions via crypto rather than the traditional banking system. So actually, on that front, Future Forex has developed a product which allows clients to perform Forex transactions via cryptocurrency in certain jurisdictions, which obviously allows for, number one, lower fees to their clients, and also far faster transaction times. And just to clarify what I mean by that, via cryptocurrency, payments can be done in minutes, if not seconds, whereas the traditional banking system, you know how long you can wait if you've got dollars and need them to be transferred to, let's say, pounds. You know how long that can take, and you know how expensive it can be through the banks. Now, this will be a fraction of the cost. So if any of your viewers, Sage, are interested in exploring that option further, please do reach out to us for either, if you want to look at utilizing this for yourselves or for your businesses. You can reach out at info@futureforex.co.za, and we'd be happy to help if we can. Onto your second question, Sage, about how do these compare to exotic currencies like the dirham or the peso. So exotic currencies are impacted by their jurisdiction, right? And the political decisions in those jurisdictions. Whereas crypto, by comparison, isn't bound to a single country and is more of a global asset. That said, crypto definitely does link to geopolitical events, in that its price is largely speculative, right? So for example, if a first world country like the US or Australia issued a positive statement on Bitcoin or cryptocurrency in general and started regulating it more, that would likely have an increase in its price, whereas a negative statement would likely decrease the price. So there definitely are links, but it's not as impacted as an exotic currency would be to its direct jurisdiction. That said, there are definitely similarities in the price movements of exotic currencies and cryptocurrencies, in that both are seen as risky assets, which basically means that when there's a risk on sentiment globally, both would likely perform well relative to something like the US dollar or the Australian dollar, in that people are willing to spread their wealth into more risky investments with more high yielding returns. And in both cases, exotic currencies and cryptocurrencies would perform well.
Great, thank you so much. So that has almost brought us to the end of the discussion now, and I feel that we actually are gaining a lot of knowledge from you. Now, thank you for inviting our viewers to contact you in regards to your remittance product, because I have heard in South Africa that remittance fees can be quite high, and I just love the way digital assets and the capabilities of transferring peer-to-peer without the middleman is just making things so much more cost efficient and faster. And technology and people who work with it are usually solutions focused, and that's what's so appealing about the space. So Harry, your time's been so valuable, but before you go, can you also let us know or explain why different platforms and countries have varying prices for digital assets? You've talked about it a little bit, but if you don't mind elaborating, and how can traders benefit from this, please?
Yeah, Sage, I'm happy you asked this, because this really is my wheelhouse. This is what I do day to day and understand extremely well. So let's start off by saying that the reason that there would be different prices in the first place is because of some demand and supply imbalance caused by certain countries having regional restrictions on, let's say, the flow of capital or cryptocurrencies, right? And this would in turn result in their local exchanges pricing something like cryptocurrencies at a premium. And perhaps the best example, and the one I'm most familiar with, is my country, South Africa. So in South Africa, cryptocurrencies trade at a 2 to 3% premium compared to abroad. And the reason for this primarily is that there are foreign exchange allowances which limits each South African individual to 11 million rand per year. Now that's around 980,000 Australian dollars, which can be sent offshore. So even if you're a billionaire, you can only send plus minus $980,000 offshore. What this will end up doing naturally is, because there are restrictions on getting out of South African rands, South Africans are willing to pay a premium to be exposed to a global asset like Bitcoin without impacting their 11 million rand allowance. And for this reason, the price of Bitcoin, because of the lack of supply and excess demand, the price of Bitcoin and other cryptocurrencies trades at 2 to 3% higher than that abroad. Now, we take the opposite approach here as a company. Future Forex instead utilize this inefficiency to make profits for our clients by sending their money offshore through the traditional banking system. So sending their money to the US through the traditional banking system, purchasing cryptocurrency in the US, and simultaneously selling that cryptocurrency in South Africa at a profit. And now we've hedged this entire process as a company to ensure that there are no price or Forex fluctuations to our clients. So using this mechanism, we've now processed over 2.7 billion rand, which is about 240 million Australian dollars, and have never made a single loss for any of our clients because of this hedge mechanism. So it really is a sustainable way of making excess returns for clients. And I mean, myself coming from a finance space, being an actuary by trade, I've never seen returns like this, you know, so it really excites me that this is sustainable, it works. It's a really, really exciting space to be in. And DeFi in general, there are plenty of opportunities that present themselves. Unfortunately, there are also plenty of risks. So if you have the right understanding, if you find a company that you trust, that you know that they're doing the right thing, there really can be quite exceptional returns. And that's why I do invite your clients, if they are interested in anything like this, to reach out to us, because we're happy to look at other opportunities, particularly in the remittance space. And Sage, I just want to say thank you so much for inviting me on. It's been lovely.
Yes, thank you so much, Harry. I'm just a little bit overloaded with the information. You've just been a wealth of information. Thank you so much for sharing with us the benefits of working in South Africa in your space of high yield arbitrage trading. It's been very interesting indeed. And
thanks, Sage. I really appreciate that.
Yes, well, viewers, this is Harry Schertzer, the CEO of Future Forex in South Africa. Please do reach out to him if you'd like to find out more about his products and services. And if you missed any part of the interview, it is available at kalkinemedia's YouTube channel. So please check it out and keep watching for more of these great expert talks and market insights. Until the next episode, stay apprised and invest wise with Kalkinemedia.